Investing can seem daunting, especially when you're just starting out. Many believe you need a lot of money to begin. However, that's a misconception. Even with a small amount like $100, you can take your first steps towards financial growth. This essay will explore 5 different investment strategies for beginners. We'll examine their learning curves, passive income potential, tax implications, and risk levels. We'll also review their hypothetical performance over a 4-year period. Remember, this is for informational purposes only, not financial advice. Always do your research and consult a financial advisor before making investment decisions. Investing is about more than just making money. It's about taking control of your financial future. Every journey starts with a single step. In the world of investing, that first step can be as simple as investing your first $100. Don't underestimate the power of small beginnings. Over time, even small contributions can grow significantly through the power of compounding. Compounding is the concept of earning returns on your initial investment and on the accumulated interest. This essay aims to demystify the world of investing and provide you with the basic knowledge to start your journey. We'll delve into different investment options, highlighting their pros and cons. Remember, the best investment strategy is one that aligns with your financial goals, risk tolerance, and time horizon. Individual stocks represent ownership in publicly traded companies. Investing in stocks can be an exciting way to participate in the growth of businesses you believe in. However, it also comes with a steep learning curve. Understanding how to evaluate companies, read financial statements, and analyze market trends requires time and effort. While stocks have the potential for high returns, they also carry significant risk. Individual companies can be volatile, and their stock prices can fluctuate wildly. A poorly performing company can lead to substantial losses. Passive income from stocks comes in the form of dividends, which are a portion of the company's profits distributed to shareholders. However, not all companies pay dividends. Tax implications for stocks vary depending on your country of residence and how long you hold the investment. In some countries, long-term capital gains may be taxed at a lower rate than ordinary income. Overall, investing in individual stocks is considered high risk, but it can potentially yield high rewards for those willing to put in the time and effort to learn. Real estate investment trusts, or REITs, offer a way to invest in real estate without owning physical property. REITs are companies that own, operate, or finance income-generating real estate. They offer a relatively easy way to diversify your portfolio with real estate assets. Investing in REITs comes with a moderate learning curve. Understanding the different types of REITs, their underlying assets, and market factors that can affect their performance is crucial. REITs offer passive income potential through dividends, which are typically paid out more frequently than stock dividends. The tax treatment of REIT dividends varies by country. In some jurisdictions, REIT dividends may be taxed as ordinary income, while in others, they may qualify for preferential tax rates. REITs are considered a medium-risk investment. They offer the potential for growth and income, but are still subject to market fluctuations and economic downturns. Section 4. Cryptocurrency, a wild ride to riches. Cryptocurrencies, like Bitcoin and Ethereum, are digital currencies that use cryptography for security. The cryptocurrency market has gained significant attention in recent years, with some investors experiencing substantial gains. However, it's crucial to understand that this market is highly volatile and speculative. Investing in cryptocurrency requires a moderate learning curve. Understanding the technology behind it, the different types of cryptocurrencies, and the risks involved is essential. While some cryptocurrencies offer passive income opportunities through staking or yield farming, these methods often come with their own set of risks. Tax laws surrounding cryptocurrency are still evolving and vary significantly by country. It's crucial to stay updated on the latest regulations regarding cryptocurrency taxation in your jurisdiction. Cryptocurrency is considered a high-risk investment due to its extreme price volatility and the potential for regulatory changes. Section 5. Gold, the steady but slow investment. Gold has been a store of value for centuries. Investors often turn to gold as a safe haven asset during times of economic uncertainty. Gold is a tangible asset, unlike stocks or bonds, and it has intrinsic value. Investing in gold requires minimal learning. You can purchase physical gold in the form of bars or coins, or you can invest in gold ETFs or mining companies. Gold does not generate passive income. Its returns come from the appreciation of its price. The tax treatment of gold varies depending on your country of residence and how you hold the investment. In some jurisdictions, capital gains from selling gold may be subject to taxes. Gold is considered a low-risk investment, but it typically offers lower returns compared to stocks or REITs. It's often used as a hedge against inflation or to diversify a portfolio. Section 6. Index funds. The power of diversification. Index funds are a type of mutual fund or ETF that tracks a specific market index, such as the S&P 500. Investing in index funds offers instant diversification by spreading your investment across a basket of assets. Index funds are very easy to understand and manage, making them suitable for beginners. They offer passive income potential through dividends paid out by the underlying companies in the index. The tax efficiency of index funds varies depending on the specific fund and your country of residence. Index funds are considered a low-risk investment compared to individual stocks or cryptocurrencies. They offer a way to participate in the overall market growth while minimizing the impact of individual stock volatility. Over the long term, index funds have historically provided competitive returns. Section 7. Final thoughts. Your journey to financial freedom. Investing your first $100 is a significant step towards taking control of your financial future. Remember, investing is a marathon, not a sprint. The key is to start early, stay consistent, and diversify your investments. Before making any investment decisions, it's crucial to conduct thorough research or consult with a qualified financial advisor. They can help you create a personalized investment plan that aligns with your financial goals, risk tolerance, and time horizon. This essay provides information for educational purposes only and should not be considered financial advice. Tax laws and regulations vary significantly by country, so it's essential to consult with a tax professional to understand the specific implications for your situation. Investing can be a rewarding journey. By starting small, learning continuously, and staying committed to your financial goals, you can pave the way to a more secure and prosperous future. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more tips on online money-making opportunities.